Could the decline of the middle class crash the stock market? A thought-provoking question, isn't it? It's no secret that the middle class has been on a downward trend for a while now, but have we stopped to consider what this could mean for the stock market? Could this erosion of the middle class lead to a significant downturn in our economy? What are the potential implications for investors and the overall financial landscape? Intrigued? Stick around as we delve deep into this fascinating topic. The middle class, often seen as the backbone of the economy, is undergoing significant changes. Traditionally, this demographic has represented a sizable chunk of the population, boasting a robust purchasing power that drives consumer demand and stimulates economic growth. They are the ones who buy homes, cars, appliances, and send their children to college. In essence, their spending habits keep the wheels of the economy turning. But what happens when this crucial segment starts to shrink? When the middle class contracts, it can create a chain reaction that ripples throughout the entire economy. Fewer middle-class families mean fewer consumers making those key purchases that fuel economic expansion. This decline in demand can lead businesses to cut back on production, leading to job losses and a slowdown in economic activity. Moreover, the middle class also plays a vital role in tax revenue generation. They often shoulder a significant share of the tax burden, funding public services and infrastructure that are essential to the functioning of the economy. As the middle class declines, this revenue source can dwindle, potentially hampering the government's ability to maintain these services. But it's not just about numbers, it's also about the purchasing power of the middle class. Over the past few decades, we've seen stagnating wages, coupled with rising costs of living. This has led to a decrease in the middle class purchasing power, further straining their ability to contribute to economic growth. And then there's the issue of wealth distribution. As the middle class shrinks, wealth becomes concentrated in the hands of a few, leading to increased economic inequality. This polarization can have a destabilizing effect on the economy and society at large. In sum, the middle class, with its significant role in driving demand, generating tax revenue, and maintaining a balanced wealth distribution, is a vital cog in the economic machine. Changes to this demographic, including a decline in numbers and purchasing power, have far-reaching implications for the economy as a whole. But how does this link to the stock market? Let's delve deeper. The stock market and the middle class are more intertwined than you might think. To grasp the connection, let's first simplify the concept of the stock market. Essentially, it's a place where shares of public companies are bought and sold. The price of these shares is determined by a multitude of factors, but one of the key drivers is the company's profitability. And guess what? The profitability of many companies, particularly those in the consumer goods and services sectors, is highly dependent on the spending power of the middle class. Now let's break down the role of the middle class. It represents a significant portion of the population, and it's known for its spending habits. The middle class is the primary consumer base for many industries, from retail and automotive to housing and travel. The money that the middle class spends on goods and services contributes to the revenue of companies. These companies, in turn, report their revenue and profit numbers to the market, and these figures influence stock prices. In essence, the middle class fuels the engine of many businesses. Their spending habits influence the financial health of companies, which is reflected in their stock prices. So when the middle class is thriving, with more disposable income to spend, it can lead to higher revenue and profits for companies, potentially driving up their stock prices. But what happens when the middle class isn't doing so well? When disposable income shrinks, so does spending. Fewer purchases mean less revenue for companies. And with less revenue, profits can take a hit, which can then negatively impact stock prices. Consider a simple scenario. Let's say a significant portion of the middle class decides to cut back on their coffee purchases due to financial constraints. This reduction in spending could cause a dip in the revenues of coffee chains, which could then lead to a decrease in their profits. If these coffee chains are publicly traded companies, their stock prices could potentially take a hit as investors react to the lower profits. But it's not just about coffee. It's about all the goods and services that the middle class consumes. From cars and houses to clothing and entertainment, the spending habits of the middle class have a wide-reaching impact on the economy, and by extension, the stock market. So the prosperity of the middle class and the performance of the stock market are indeed interconnected. The two can influence and reflect each other in a cyclical pattern. A thriving middle class can lead to a robust stock market, while a struggling middle class might signal potential troubles ahead for stocks. So, a decline in the middle class could indeed ripple through to the stock market. But how? A shrinking middle class could spell trouble for the stock market. This ominous statement might sound like a line from a doomsday movie, but it's far from fiction. As we've explored in the previous scenes, the middle class is the backbone of the economy. When it falters, the ripple effects are felt far and wide, even in the world of stocks and investments. Let's imagine a scenario. Picture a vibrant, bustling city. The heart of this city is its middle class, the hardworking folks who drive the economy. They are the consumers, the spenders, the investors. They buy products, pay for services, and invest in their future. Their spending fuels the economy, drives company revenues, and in turn, bolsters stock prices. This is the cycle of economic growth. Now, what happens if this heart begins to beat slower? If the middle class starts to shrink, the city's vibrancy fades. With fewer people in the middle class, there's lower consumer spending. This is because the middle class has less disposable income to spend on goods and services. This decline in spending can lead to lower company revenues. Remember, company revenues are a critical factor in determining stock prices. When a company's revenues fall, it's often reflected in the company's stock price. So a decline in middle-class spending could cause stock prices to fall. Now let's add another layer to this scenario. The middle class isn't just a group of consumers, they're also investors. They invest in stocks, bonds, and other financial instruments. These investments help fuel the stock market's growth. But what happens if the middle class can no longer afford to invest? As the middle class shrinks, there's less money being invested in the stock market. This decrease can lead to less liquidity in the market. Liquidity, as some of you might know, is the lifeblood of the stock market. It's what allows investors to buy and sell stocks easily. Without sufficient liquidity, the stock market could become more volatile, leading to larger swings in stock prices. Furthermore, a declining middle class might mean fewer people are investing in retirement funds, such as 401(k)s and IRAs. These retirement funds often invest in the stock market, providing a steady stream of capital. If fewer people are contributing to these funds, there could be less capital flowing into the market. This paints a rather grim picture, doesn't it? A shrinking middle class leading to lower spending, impacting company revenues, causing stock prices to fall, and potentially decreasing investment in the stock market. It's a chain reaction that could destabilize our economy and the financial landscape as we know it. However, it's important to note that this is a potential scenario. There are many factors at play in our complex economy, and the stock market is influenced by a multitude of elements. While a declining middle class could have these effects, there are also counteracting forces and measures that could mitigate these impacts. But what does this mean for the future of the stock market? We're about to delve into that in the next scene, so stay tuned. This is a conversation we all need to be having, as the health of the middle class and the stock market are intrinsically linked. Let's continue to explore this critical topic together. The future of the stock market may be more linked to the fate of the middle class than we realize. This connection isn't just an economic theory, it's a reality that we may be witnessing unfold before our very eyes. Let's delve into the potential implications of a declining middle class on the stock market and the economy at large. Firstly, a shrinking middle class could lead to a decrease in consumer spending, which in turn could negatively impact the profitability of many companies. As we know, the stock market is a reflection of corporate profitability. If companies are not making as much money due to less consumer spending, their stock prices could potentially fall. This is a straightforward, yet profound connection between the middle class and the stock market. Secondly, a dwindling middle class could lead to increased market volatility. With fewer middle-class investors, the stock market could become more susceptible to the whims of wealthy investors. These investors tend to be more risk-tolerant, which could lead to more dramatic ups and downs in the market. Thirdly, a declining middle class could also impact the housing market. The middle class is a significant portion of the housing market, and their ability to buy homes can impact real estate companies, construction companies, and banks, all of which are represented on the stock market. A decline in the middle class could mean a decline in these sectors as well. Now, let's consider some possible future scenarios. If the middle class continues to shrink, we could see a significant downturn in the stock market. A less robust middle class could lead to a less robust economy, which could in turn lead to a less robust stock market. However, if efforts are made to strengthen the middle class, such as through policies that promote wage growth and job stability, we could see a more stable and potentially thriving stock market. It's important to note that these are just potential scenarios. The stock market is influenced by a myriad of factors, and it's impossible to predict with certainty what the future holds. However, what we can say with certainty is that a strong middle class is crucial for a healthy stock market. In conclusion, the implications of a declining middle class on the stock market are multifaceted and far-reaching. It's not just about numbers and percentages, it's about the livelihoods of millions of people and the health of our economy. It's a topic that deserves our attention, and one that we must continue to explore and understand. Let's summarize what we've learned today. Today, we've explored the intricate relationship between the middle class and the stock market. We've journeyed through the avenues of our economy, dissecting the vital role of the middle class, the backbone of our economic structure. We discussed how this significant sector of society contributes to consumer spending, underpins demand for goods and services, and ultimately powers the economic engine. Next, we connected the dots between the middle class and the stock market. We highlighted how the financial health of the middle class impacts stock market trends. It is this section of society that invests in mutual funds, retirement accounts, and individual stocks, thereby influencing the market's performance. A strong and prosperous middle class can lead to a robust and thriving stock market. However, we also delved into the darker side of this relationship. We examined the potential impact of a declining middle class on the stock market. As the middle class shrinks, there is less disposable income to invest, leading to lower demand for stocks. This can trigger a decrease in stock prices, thereby causing the stock market to falter. This decline can have a ripple effect, impacting not only individual portfolios, but also the broader economy. Finally, we looked into the crystal ball and discussed the future implications for the stock market. As the gap between the rich and the poor widens, with the middle class caught in the crossfire, there could be greater market volatility. We could see more dramatic swings in stock prices, potentially leading to increased financial instability. In essence, the middle class and the stock market are two sides of the same coin. They are interdependent, with the health of one directly impacting the other. As the middle class goes, so goes the stock market. This exploration is not meant to incite fear, but to foster understanding. By comprehending these dynamics, we can better anticipate economic trends and make informed investment decisions. Knowledge is power, and understanding how our economy functions can give us the tools to navigate the financial seas with greater confidence. So, as we conclude this deep dive, let's keep probing, questioning, and learning. It's through this process of inquiry and understanding that we can make sense of the complexities of our economic landscape. Understanding these dynamics can help us anticipate economic trends and make informed investment decisions. Until next time, keep exploring and keep learning.